Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today is Tuesday, August 1st, 2023, and this is our monthly market monologue, where we will walk through some of the results from the month of July, as well as the year-to-date stats in the stock market. I'm also going to provide a few charts on the economic activity that we see and continue to share our thoughts with you in that regard as well. However, for those of you that are new to our channel, I would be remiss if I didn't introduce you to Hicks & Associates Wealth Management. We serve clients, individuals and families in a proactive approach. We serve them by being intimately familiar with their finances so we can guide their financial decision-making with data-backed advice. For most of our clients, we also serve as their portfolio manager, managing their investments in a truly active, fiduciary, and fee-based approach. If you'd like to learn more, just drop us a line at hicks-associates.com, or you can certainly email me directly. That said, let's dive in and take a look at the stock market, starting with the S&P 500. So here we have the monthly candle chart for the S&P 500. Again, every candle on the screen represents a month in time. So the most recent candle on the far right side represents July. A strong month, not obviously as strong as June, as you can see, but still a very positive month. We'll come back to that in just a minute. You can also see the price measurement that I've put on the screen. We are approximately 5% away from that all-time high. If we get there this year, we would certainly expect a little bit of a battle before we break through, but we'll talk about that as we get closer. Moving on to the NASDAQ, this is the NASDAQ monthly candle chart. Again, solid month for the tech-heavy index. Remember, one of the things we've been talking a lot about is how both the S&P 500 and the NASDAQ and a lot of the indices that you're used to hearing about, NASDAQ and the S&P 500, again, are both cap weighted. So the biggest stocks in these indexes move the indexes the most. We'll come back to that in just a minute. So again, another positive month for the NASDAQ. Before talking about the Russell 3000, if you find these videos helpful, we want to stop and encourage you to hit the subscribe button here on YouTube if you have not done so already. Also, if you find these videos helpful, please, by all means, hit the like button and give us a thumbs up. That does help the algorithms and help the channel continue to grow. So we certainly thank you for that. That said, the Russell 3000, in our opinion, does a better job of measuring the overall U.S. stock market because the Russell 3000 is going to capture approximately 95% of the stocks that are traded in the United States. So again, you see the far right candle is the month of July. You can see that it was indeed a good month. Not as strong as June, but still a good month. However, we also want to show the consolidation pattern that we were witnessing in the broader U.S. stock market. This is one of the reasons why, for our clients, we were very cautious the first several months into the year, is because we could see this consolidation. There was, yes, the S&P 500 was going up, yes, the NASDAQ was going up, but the reality is the first part of the year, it was really just a handful of stocks that were moving those indexes the most. When we look at the broad U.S. stock market, there was a big resistance level that we really needed to see broken before we could get too aggressive. Well, that happened at the beginning of June, and so far that is continuing. Now, we want to look at the New York Stock Exchange Composite Index next, and that is on the screen here. Remember, this is all the stocks that are traded on the New York Stock Exchange, and again, we see a very positive month of July. That was following an even more powerful month of June. But this index, as you'll see in just a minute, has not been as strong as the S&P 500 and the NASDAQ. And that is, again, because of the way that these stock indexes are measured and what's going into those measurements. We'll come back to that in just a second. However, now let's take a look at small cap, because this is a really important development. As we've been discussing, we saw that consolidation period in the Russell 3000 where we really needed to see the broad U.S. stock market break through that, and that has happened. Well, what we're really starting to witness now is the small caps. Small caps are referring to the smaller companies. So think of large caps just oversimplistically. Large caps are names that you likely know. Small caps are stocks that you might not have ever heard of. Well, all the large cap stocks were once upon a time small caps. So they were once upon a time small. They want to grow to be medium and then large, etc. Well, in a typical healthy bull market, small cap stocks tend to be pretty strong. Well, small cap stocks this year were strong up until I think February 2nd, I think was when we had that high, and then they consolidated and pulled back in. Well, they're beginning to recover, and you can see I've drawn this green line that represents a little bit of a resistance area, but small cap stocks are beginning to break through that, and that is a really encouraging sign for the overall U.S. stock market, and we can see that by looking at a relative comparison chart. And so this is the S&P 500 for the month of July. It was up approximately 3%. The New York Stock Exchange Composite Index was up about 3.2. Then the Russell 3000 again up at 3.4. Then NASDAQ, okay, but here is the Russell 2000. This is how I'm measuring small caps in this particular instance. Up almost 6% in the month of July. That is a very good sign for the broader U.S. stock market. I'm showing this table to try to again highlight the big difference between the S&P 500 and the NASDAQ and then the rest of the U.S. stock market. Remember, the NASDAQ and the S&P 500 are both cap-weighted indices. What that means is that the biggest stocks in those indices have the most influence in how these performance calculations are run. So the Microsofts, the NVIDIAs, the Googles, etc., those really big companies have an outsized influence on how these returns are calculated. And that gives a disparity, that gives an illusion that everything is going well. And that's not really true. So here we have at the bottom of the chart is a Dow Jones Industrial Average. That index is up only approximately 7% for the year. Now, the bad news on showing you this is that we recognize there's only 30 stocks in that index. We get that. Well, then you look at the New York Stock Exchange Composite Index, and you see that index is up only about 8%. Climbing the ladder one more, you see the small cap index is up 9.8. But remember what I just showed you in the last chart. Small caps rose about 6% in the month of July. So what we're trying to show here is there's a big disparity between the S&P 500 and the NASDAQ and the rest of the U.S. stock market, but at the same time try to encourage you that the stock market is beginning to get broader and broader participation. Again, that small cap sector, the fact that it performed so well last month is really encouraging news. However, we do need to also factor in what we call seasonality. So this is our seasonality chart, and what we're showing here is the average monthly performance for the S&P 500 since 1950. And you can see this blue dot represents July 2023, well above the average month of July. But I really want to call your attention to the historical precedent for August. August is historically not a very good month for the stock market, and September is even worse. Now, that is the S&P 500. Let's look at the S&P 600, which is the small cap index. Now, the problem here is, if you can see the small print, it says 1995 to 2023. The reality is the small cap index really didn't exist before 1995, and so we don't have data prior to that. But since 1995, again, you can see August and September are typically very weak months. So as good as it is to say that the small cap space is finally participating, that's a very good sign, we are also seasonally aware that August and September tend to be very challenging months. So two more charts, and then we'll land the plane by looking at a couple of economic data points that you might find interesting. On the screen now is the year-to-date performance of the sector ETFs. So the S&P 500 is broken into 11 different industry sectors. So those industry sectors, they're on the screen now. But I want to highlight the fact that these sector ETFs are also cap weighted. And so you can see XLK is the technology sector ETF. It's up approximately 45% year to date. Well, you'll see in a second a big disparity between this index and a equal weighted index. I'll show you what I mean in a second. XLC is the same thing. XLC is heavily influenced by one or two stocks. Same thing with XLY. Very heavily influenced by just a handful of stocks, and I'll show you in just a minute. And you see this wide gulf between these top three sectors and just about everything else. And there are still two sectors, sector ETFs that are negative for the year. You've got utilities, which some people claim that the utility space, or that's a quote-unquote safe place to invest. Well, negative 5% is not necessarily safe, even if you are getting a decent dividend on that. And then XLV is healthcare. Those two sectors are technically negative for the year. However, let me show you the difference between these cap-weighted ETFs and a equal weight ETF. So I know this is small print, but I'll try to guide your eye. We're really going to look at this column right here. This is the year-to-date column. On the left-hand side of the screen, you'll see that I've got XLY and RSPD. So this is the discretionary sector. And if you look, you see that the cap-weighted ETF up almost 35% for the year versus the equal-weighted ETF is up only 21%. Now, what do I mean when I say equal weighted? I think in the last video, either last week's video or the one before, I gave the analogy of Michael Jordan and trying to use basketball as an analogy or to help describe what do I mean when I say cap weighted. And what I said was, imagine, if you will, a scenario where the National Basketball Association says, well, Michael Jordan is such an important basketball player that when he shoots a basket inside the three-point line, well, we're technically going to give him 6 points because he's such an important player. But if he shoots a basket outside of the three-point line, well, we're actually going to give him 9 points because he's such an important player. Well, many in the basketball league would say, hey, that's not fair. Well, that's kind of how the cap-weighted indexes are calculated. They are putting outsized influence on a handful of stocks versus an equal weight ETF is saying, well, we're going to count all the baskets the same. So all the stocks that are in this discretionary ETF, they're all influencing the year-to-date performance the same. So there is a big disparity between those two, the cap-weighted and the equal weight. And you can see there's a little bit of difference here in the healthcare sector. The cap-weighted sector is actually negative. The equal weight is actually positive. So you can see some of these differences. I'll highlight the technology sector. Here we are right here. XLK is the cap-weighted sector ETF. It's up 43% for the year, but the equal weight is up only 25%. So there's a big difference between these cap-weighted indexes and the equal weight version. And then we'll show one more at the bottom. This is communications. Communications sector ETF up 43% for the year versus the equal weight version up only about 14, almost 15%. And I think this one is heavily influenced by Meta, which is basically Facebook. So we'll look at two economic data points and then we'll wrap up for the day. On the screen right now is the unemployment rate. This is the federal unemployment rate. And if you look at the bottom right, you see that we are currently at 3.6%, which is a very healthy figure. The other thing I want to highlight on this chart is 7.5%. So several months back, there was two researchers, I believe, from the International Monetary Fund that released a paper. And in this paper, they declared that based upon their research, that the unemployment rate here in our country would have to be greater than 7.5% in order for inflation to be considered under control. That was their declaration. Well, since then, the inflation rate has come down from the 40-year high all the way back down to 3.1. That's the latest update. We're at 3.1% inflation right now, which is very close to the 10-year average of about 2.6%. So you could easily argue that the Federal Reserve has done a pretty good job of bringing inflation back down. I won't go so far as to say that I believe it is under control just yet, but they've at least done a pretty good job of bringing it back down fairly quickly. And we're nowhere near what these International Monetary Fund experts predicted that we would have to be on this unemployment rate. So I say this to say that make sure that when you're reading economic commentary or you're reading research or something like that, or you're listening to it in the news, we would encourage you to have a healthy dose of skepticism, and because sometimes they're just flat out wrong. Now, let's look at the North Carolina unemployment rate. Right now, the North Carolina unemployment rate is 3.3%. Again, you have to go back all the way to January of 2000 in order to find a North Carolina unemployment rate lower than what we're at right now. These data points on unemployment are two of the reasons why we continue to doubt that we're going to see a recession in this calendar year. Remember, when this year started, we had the highest number of economists ever declaring that we were going to see a recession in 2023. We've been skeptics from the very beginning in this regard, and we continue to see evidence that does not suggest that we're going to see a recession yet. Is one coming? Yes, I think so. When? I don't know. There are some signs, like the yield curve. We talked about that last week. There are some signs that a recession is coming, but that could still be quite a ways off. Last thing we want to talk about today is manufacturers' new orders. Now, the keen eye might notice that this chart is not updated. I'll show you the updated chart in just a second, but I want to make sure we draw a distinction between last month's data and this month's data, because manufacturers' new orders is another leading economic indicator. And in last month's monthly market monologue, we talked about how this was one of the data points that to us was not suggesting a recession, because this data had come in a little bit, but it had corrected and it was an encouraging sign that it was growing again. Well, look at the latest data point. Folks, that is expansionary. That is not suggesting that we are about to see a recession. Anyway, I hope you find these videos helpful. If, again, you haven't already, we encourage you to hit the subscribe button on our channel. Again, feel free to leave us a comment in the comment sections. We do read those comments. You can also email me. You'll see my email address on the screen. If you have any specific questions, either about what you saw in today's video or what we may be able to do for you and your family, whether that's with me or either of the two advisors that are on our team, we would be more than happy to schedule a time to chat. In the meantime, we thank you for watching, and we will see you again soon.